Welcome to CoreLogic's update on the housing market for May 2018. Nationally, dwelling values continued their downwards trend last month, the 7th consecutive month-on-month decline since the national index series peaked in September last year. Generally, we're seeing growth conditions showing a mild pickup across the regional markets while capital city markets ease. CoreLogic indices show the combined regional markets recorded a 2.4% rise in dwelling values over the past 12 months, while capital city values were down by 0.3%. On a rolling quarterly basis, the performance gap is getting wider, driven by stronger conditions across the major centres within close proximity to Sydney and Melbourne, as well as more demand flowing into regional coastal and lifestyle markets. Additionally, the regions linked with the mining sector are now showing signs of bottoming out, creating less drag on the headline growth rates across the mining states. Looking at the performance based on housing types, units are now broadly outperforming houses, either by showing higher capital gains or more resilience to falling prices. While this is the case at a national level, it's really Sydney and Melbourne where the pricing gap between houses and units, as well as a surge in price-sensitive first home buyers, are supporting growth in unit values over house values. Every other capital city has seen house values outperform the unit market over the past 12 months. Another emerging trend is that the most expensive properties are leading the downturn, while properties at the more affordable end of the market have generally been more resilient to falls. While the most expensive properties are showing the weakest conditions across most cities, in Perth and Canberra, it's actually the most affordable end of the market that's underperformed relative to other broad value-based segments. The falls in home values are very much concentrated within the two largest cities, Sydney and Melbourne, where dwelling values have previously been rising the quickest. Since peaking in July last year, Sydney home values are down by a cumulative 4.3%, and Melbourne values have fallen by 1.1%. These are also the cities where investment activity has been the most concentrated, highlighting the tighter credit conditions for investors has played a large role in slowing the market. While Sydney and Melbourne are experiencing the most substantial and consistent falls, most other capital cities have also seen the rate of capital gains easing over the year to date, or they've seen some subtle price falls. Over the first 4 months of 2018, dwelling values have nudged lower across Brisbane, Adelaide and Perth, while Darwin and Canberra have recorded a subtle gain. The only market showing a consistently high rate of growth is Hobart, where values are 4.6% higher over the first 4 months of the year. As housing market conditions generally ease, other key indicators have also softened, including the number of settled sales, auction clearance rates, and credit flows. Additionally, advertised stock levels have shown a substantial rise in Sydney and to a lesser extent in Melbourne. Nationally, settled sales are down 5.7% year on year. Although there will be some upwards revision as the off-the-plan unit sales move through to settlement, it's clear that there are fewer buyers active in the market. Sydney has seen the largest year-on-year fall in settled sales activity, with volumes down 12.3% relative to the previous 12-month period. Clearance rates have generally been holding around the mid-60% range through most of 2018. More recently, though, clearance rates have been trending lower, with the final week of April seeing Sydney's clearance rate dip to 56% and Melbourne clearance rates also on a clear downwards trajectory. The lower clearance rates highlight that selling conditions have weakened over the past month. Unsurprisingly, housing credit, which is a key indicator of market activity, has remained weak. The Reserve Bank figures show annual growth in housing credit has reduced to 6.1% per annum, the slowest rate of growth since March 2014. Weaker credit growth is a result of less investment activity, with annual growth in investment lending tracking at just 2.5%, compared with owner-occupier credit, which is up 8.1% over the past 12 months. Of course, it isn't just credit policy working to slow down housing conditions. Despite lower prices, affordability remains a pressing issue, especially in Sydney and to a lesser extent Melbourne. Our latest dwelling price to income ratios put Sydney dwelling prices 9.3 times higher than gross household incomes, and Melbourne prices are 8 times higher than household incomes. Other capital cities are showing much lower ratios, highlighting that housing prices haven't outpaced income growth as much. In fact, on this measure, housing affordability has improved substantially across Darwin and Perth, as dwelling prices have trended lower and incomes have posted a modest rise. The outlook for the housing market will be largely dependent on how credit policies play out with regards to banks' appetite for lending. Although APRA has announced it will lift the first macro-prudential policy, that's a 10% speed limit on investment credit growth, we aren't expecting this to have a material impact on credit availability. Lenders are likely to be focusing more on overall debt serviceability, as well as validating borrower expenses and incomes, and minimising high debt-to-income loans and low deposit loans, all of which will help to keep a lid on credit growth, especially for investors who still face mortgage rate premiums and less opportunity to secure a loan on interest-only terms. Add to this the uncertainty of a federal election, which will be held sometime over the next 12 months, no doubt there will be further debate around taxation policy as it relates to housing. Changes in negative gearing and capital gains tax policies could pose a further headwind for the housing market should they be introduced. It sure is interesting times across the housing market and the economy. If you'd like to stay up to date with all the latest trends in the housing market, you'll find plenty of research content at www.corelogic.com.au.